I'm Bob, and this is Costa Doing Business, where faith, finance, family, and freedom intersect. Tonight, we're going to be doing a continuation of my last podcast on real estate. We're going to be talking about scaling smart, which is the way that you unlock real estate's full potential. But before we get to that, let me continue a concept that I introduced at the very end of my last podcast and talk about types of real estate investments. Of course, as you know, real estate is a valuable asset class, providing financial security, income opportunities, and long term wealth, which builds potential. Choosing the right type of investment real estate depends on your financial goals, your risk tolerance, and your management capabilities. So, most people start with single family residences. There are really two types: there's the single family residence that you live in, and the single family residence that you use as a rental property. Single family residences that you live in are obviously not ideal for investment because you're going to buy something presumably a little bit nicer, or maybe with appointments that you want for you and your family, than something that you would rent. Family homes are considered liabilities rather than assets by real estate investors like Robert Kiyosaki or Grant Cardone. And this is because they take money out of your pocket instead of putting money into your pocket. It's a limited investment in that home ownership primarily benefits banks through interest over 30 years, usually, not the owners. And you pay for that property 2.5 to 3 times the purchase price. This does not include hidden costs such as property taxes, repairs, and lost mobility make single family residences a poor choice for wealth building. A CNBC study supports this claim when it states that home ownership is not a way to build wealth. It may be a place to save money, not necessarily make money. Of course, you could flip or wholesale a single family residence. That's really more of a job than an investment, because flipping refers to purchasing a home, making some improvements, and then reselling it for a profit. Wholesaling involves securing a property and selling the contract before closing so that title actually never passes to you. And while some engage in these strategies to accumulate capital, these strategies don't offer long term financial security. You kind of start from zero after each deal. And in addition, miscalculating the market, the purchase price, or holding costs can quickly erode your profits. Because there is no income other than at the sale, flipping and wholesaling do not provide sustainable long term income. Single family home rentals are hard to scale and often subject to predatory lending. Investors have attempted to build portfolios of single family rentals, particularly or some in low income areas. Some provide lease to own agreements, but if tenants miss payments, they are removed and the lease to own is done again, leading to frequent turnover. Managing individual homes is very labor intensive for the owner and difficult to scale. Even government supported low income rentals, such as Section 8 housing, limit upside potential as government policies affect and basically control revenue growth. You could move into a duplex or even a fourplex and get other people to share in your housing costs. This is an entry level investment, but sometimes is a little bit risky because smaller multifamily buildings, which are typically defined as up to 4 units, are common for beginners due to low down payments and accessible loans. However, these properties offer insufficient cash flow to hire a professional management company. And it basically means that you are going to rely upon your personal involvement to collect the rents, typically cut the lawns, do minor repairs, and basically do the work. And when a vacancy does occur, losses are steep in a fourplex or a duplex. So, for example, if one tenant moves out of a fourplex, the investor instantly loses 25% of their income. Properties under 4 units tend to suffer foreclosure more frequently due to economic downturns. Then we have commercial multifamily properties, which is 5+ units. Now, I am really becoming a fan of this particular category um, for a variety of reasons. I've introduced this particular subject as being scaling in real estate. What is scaling? Business owners and leaders have talked in recent years a great deal about scaling. Scaling is sort of like the corner store that is family owned and sells a variety of products that are also sold at a local Walmart, for example. Because of Walmart's purchasing power and because they can buy in massive quantities, the Walmart actually pays a much lower price than the local convenience store, which may be buying the same products, but because of the quantity, they're buying them at a much higher price, which means they have to charge more. And ironically, Walmart can charge less and still make a profit because of scaling. It's the quantity that they're able to buy and sell, and the lower cost and the greater sales revenues that we refer to as scaling. Now, how does this apply to real estate? Larger multifamily properties and commercial real estate offer economies of scale, allowing investors to generate substantial cash flow while reducing operational headaches and vacancy risk. So, in our previous example, if you lose one tenant in a duplex, your income goes down by 50%. But if you lose one tenant in a 50-unit apartment complex, your income goes down by 2%. Conversely, if you raise a single family rental rate of $800 a month by $100, you make an additional $1,200 of rent per year. That's $100 a month times 12 months. So you make $1,200 more than you would have in the previous year. But if you have that 50 rental unit apartment complex, all of which are at $800 a month, and you raise the rents by the same $100, you just increased your rental income by $60,000 per year. That's called scaling. So, in other words, the one door or one unit in the single family house only raised your rents by $1,200 a year, but because of the scale of the 50-unit apartment complex, $100 times 50 times 12 months is $60,000. We call that scaling. And you can see very quickly how that would massively increase your personal wealth. While smaller deals might appear easier to purchase and less risky, they actually fail to generate meaningful returns because they lack scale. The key ingredient for real estate success, cash flow, location, and scale, are difficult to achieve with smaller properties. Furthermore, and this is an irony, if you buy a single family house for, let's say, $200,000 and you rent it for $1,000 a month, and you buy a multifamily apartment complex and you can rent those units for the same $1,000 a month, it is highly probable that you will pay less, substantially less, than $200,000 a door. So, in total, or on a per unit basis, you're actually paying less money to generate the same per unit income. And because of the scale of the property, meaning the number of doors, you have actually massively increased your cash flow. Large apartment complexes allow for efficient professional management, stable rental income, and better appreciation potential because in the commercial world of real estate, the value of a building is directly connected to the rent roll as opposed to the specific appointments or neighborhood of a single family. When we measure the value of a single family, you're typically going to do comparable sales in that neighborhood, which means the price per square foot of what similar houses are selling for. But when you raise the rent roll in a commercial real estate, like a multifamily, you have actually increased the value because the increase of the apartment is actually based on the rent roll, not necessarily improvements that you make to the building itself or the landscaping or whatnot. The importance of scale and professional management in real estate cannot be underestimated um, because in smaller unit properties, the gross revenue may seem promising, but once you factor in expenses, vacancy rates, profitability begins to shrink significantly. Without sufficient income, hiring a professional property manager becomes difficult, if not impossible, relying in mismanagement, subpar tenants, and ongoing financial struggles. But you might say, I don't have the cash to do a multi unit deal because banks are going to require a substantial down payment. And in the past, this has been true, typically 25 to 35% for commercial loans. And this required investments or investors to choose properties that could demonstrably prove huge revenue streams to cash flow the debt. And you would be right until very recently. But I told you in my last um, installment that I was going to show you a new program that allowed you to invest in multi-unit properties with a much lower down payment. And I'd like to do that right now. Fannie Mae has introduced a new mortgage program allowing buyers to purchase multifamily homes with just 5% down, which significantly reduces the upfront cash needed for investment. Previously, down payments could be 25% for triplexes or fourplexes or more, making it difficult for new investors to enter that market. Key features of this Fannie Mae 5% down multifamily loan, of course, is the lower down payment, only 5% required for owner occupied multifamily properties up to 4 units. And there's another program that allows for 5% down on more than 5 units. Loan limits for 4 units or less. The minimum loan value is set at $1,396,800. meaning that you could buy a fourplex for up to $1.4 million with just 5% down, which allows for larger property purchases with less cash. No self sufficiency test is required by this loan. This is a remarkable feature because previously, buyers of a 3 to 4 unit property had to prove that rental income covered the mortgage payments plus, usually to a ratio of about 125%. That is not required for this loan. And future rental income is considered, not just past rental income. So, in other words, lenders can factor in projected rental income increases to help buyers qualify more easily. It applies to various loan types. It's available for standard purchases, no cash out refinances, home ready and home style renovation loans. So if you have existing multifamilies, they may well qualify for this program. This program makes it easier for first time investors and house hackers to buy multifamily properties, live in one unit, and rent out the others for income. It also provides an alternative to FHA loans, which require self sufficiency tests for 3 to 4 unit properties. Now, why are large multifamily properties superior? I think apartment complexes and large commercial real estate uh, holdings are best for investment strategies due to their ability to scale, their generating passive income, and attract professional management. When you invest in a smaller residential property, it often leads to a high effort, low reward situation in which investors have to work harder and struggle to grow their wealth. Key factors in commercial real estate loans are another reason why commercial multifamily might be preferable to single family or small unit deals. And specifically, I'm talking about financing. In smaller deals, financing is based on your income, your credit rating, your other assets owned, because you're probably going to have to guarantee that loan. But in larger unit deals, the financing is actually easier in many respects. It's based on the income of the deal, not so much your income. It's based on the value of the deal, not your assets. And it's based on the track record of the manager of the property, which in this case should not be you. You ought to hire competent professional management to run your property and then sell that to the bank when you're going for financing because you don't have experience running a 100 unit apartment complex, but professional managers do. And you can sell their experience on your financing. Banks evaluate four main criteria before approving a commercial real estate loan. The first criteria is the asset itself, the property, its location, its financial performance. There's a good chance that if you're buying an existing property, it's actually got a track record. You can take financial statements, what we call trailing financial statements, of 12 to 24 months of income, and the lender will analyze the historical financial records to determine profitability and stability. Your credit score and net worth might factor in to the credit worthiness of the deal, but in all likelihood, that is secondary to the deal itself. Strong financial standing is always a good idea to secure loans, but in the case of a multifamily, it's not the only factor, which is very different from single families, where it may be a deciding factor. Experienced managing or managers for these properties, even wealthy individuals with excellent credit, might be denied if they lack experience in property management. But property management demands significant attention and specialized skills. Investors must handle tenant interactions, leases, maintenance, budgeting, making real estate akin to running a retail business without a commissioned based income. The reason that most people don't invest in rental real estate is the three or the two T's: tenants and toilets, collecting rents and fixing the proverbial leaky toilet underscores the challenges that small property owners face. However, larger multifamily deals eliminate these challenges through the use of a management company. There are other types of commercial real estate investments, of course. There are retail properties like shopping centers and malls that lease space to much smaller businesses such as salons, restaurants, and coffee shops. However, many small businesses struggle financially. As a matter of fact, 4 out of 5 fail in the first 5 years, making it risky for property owners relying on them for steady income. In addition, the shift from brick and mortar retail to online retail shopping has created vacancies in such real estate, which lowers property values, making it more difficult to obtain financing. So I am not a big fan of commercial retail space. However, I am a big fan and actually own the category of office buildings. Single or multi tenant office spaces generate income through longer term leases than residential real estate. In residential real estate, it's typical to have a 1 year lease. But in commercial real estate, it's not at all unusual to have 3, 5, and even 7 and 10 year leases. Um, Commercial office space usually requires significant upfront capital for both the building itself and possibly tenant improvements, which we call build outs, making them highly cost intensive investments. But I will tell you that there is opportunity in this area. I really like service businesses for office space because I find it more stable than retail space. And the value of the property is generally based on the rent roll more so than the brick and mortar itself. Real estate classifications provide investors and lenders with a standardized way to assess asset quality. Properties typically fall into 4 categories. Class A, which is premium properties, this would be luxury real estate. In this case, maybe luxury condominiums or apartment complexes, typically newer construction, under 15 years old, with very modern amenities. These types of real estate investment have lower cap rates, which we'll talk about in a future session, which is typically 2 to 4%, but they have strong appreciation potential. They are ideal for wealth preservation rather than high cash flow. Class B properties, what we call mid tier properties, were built within the last 20 years with possibly minor deferred maintenance. They are a mix typically of white and blue collar tenants. They offer balanced cash flow, 5 to 7% returns on average, and appreciation potential. Class C rental real estate has high cash flow but is maintenance heavy. These are the properties that you can get deals on because they are older, typically 25 years or more, and they require renovations. They might be located in challenging areas with higher turnover rates. But believe it or not, they typically generate very strong cash returns, 8% or more, but the upkeep costs can be significant. And finally, there is Class D, which are considered risky investments. They are found in economically depressed regions with lower employment opportunities. They sometimes experience difficult rent collection and high maintenance demands. Investors might be attracted by the low purchase prices, but properties often come with many challenges. Property classifications are somewhat subjective and can shift based on negotiation strategies. You might consider downplaying a property's class to secure better pricing or exaggerate its quality during resale. Obviously, in this case, when I say exaggerate, I don't mean lie. I mean selling its strengths while maybe minimizing its weaknesses without being deceptive in any way. Finding the right investment strategy, um, you really have to carefully consider the loan requirements, the property management challenges, the real estate classifications before making a purchase. Large scale properties offer better income potential and scalability, while smaller deals often require more direct involvement. In our next session, we will be discussing the debt bomb that makes right now the best opportunity to buy large commercial properties in years, if not ever. Please follow us on Rumble to make sure you receive notification of this podcast and upcoming discussions. I thank you for listening tonight. I'm Bob, and this is Costa doing business. Thank you and good night.